Unfortunately, the U.S. government and the body politic in the United States, the voters, I think have chosen to weaponize the dollar. Mm-hmm. And I think that other countries view that askance. Weaponize the dollar in two senses. The U.S. government has used U.S. dollar hegemony through the SWIFT banking system to extraterritorially impose U.S. power on other cultures. There was a point in time where New York was the center of global finance. The Germans in the 1950s or 1960s would have had to leave their gold in New York because it collateralized transactions that the German government entered into. There are now as many U.S. dollars outside the U.S., the so-called Eurodollar accounts, as there are inside the U.S. And the idea that Germany would need to make its gold available to creditors only in New York is nonsense. It's just as easy to borrow U.S. dollars in Frankfurt or Geneva or London as it is in New York. And regardless of what you think of the efficacy of the Russian incursion into Ukraine, the U.S. response, which was to steal $300 billion worth of Russian Treasury securities, U.S. Treasury securities, called into question the honor of the U.S. government with regards to other countries that might have policy disputes with the U.S. In a way, at least with regards to China as an example, it's probably irredeemable. Mm-hmm. The second thing I suspect in terms of Germany is the unpopularity of Mr. Trump himself and the sort of bellicose assertion of U.S. interest relative to everybody else in the world. He is personally unpopular in many places. I think this move in Germany, in one sense, reflects the German politicians' awareness of the distaste that German people have for Mr. Trump. And I think there's a lot of political populism in the move to repatriate German gold from the United States to Germany. In other words, I think it's partly a political as opposed to merely an economic act. We could have a little shakeup. I don't care. Listen, I maintain liquidity in things like the US dollar and the Canadian dollar. I save in gold. Mm-hmm. And what happens to the gold price in the near term is absolutely irrelevant to me. I hope I'm wrong, to be honest with you. You'll remember earlier in this interview, I suggested that the only way that the United States has out of its fiscal morass will be to allow substantial deterioration in the purchasing power of the US dollar. And you will remember that I discussed that in the decade of the 70s, according to the government itself, the U.S. dollar lost 75% of its purchasing power. It is not coincidental that during the period of the 1970s, the gold price ran up 30-fold. Mm-hmm. I don't want Kitco viewers to go away saying Rick Rule said the price of gold is going up 30-fold. That's not what I'm saying. Yeah. But I believe that over the next 10 years, gold's appreciation, at least in nominal terms, will mirror the devaluation of the purchasing power of the U.S. dollar. I don't own gold because I think it might go from 3,300 to 3,500. You may recall you interviewing me some time ago where I said, mm-hmm. I don't own gold because I think it might go above 2,000. I own gold because I'm afraid it's going to go much higher. If you allow the purchasing power of the U.S. dollar to decline by 75%, which is what I think happens over the next 10 years, arithmetically it makes absolute sense that as a consequence of that, the nominal price of gold rises threefold or fourfold. So I don't own gold because I hope it'll go to 3,500. I own gold because I'm afraid it'll go to 12,000. I know that my own database of investors who are interested in natural resource investing grows by about 50 people a day. Mm-hmm. What is of interest to me is that the growth in the database isn't coming from the usual suspects. The usual suspects look like me, old, fat, bald, rich, white guys. That's what the gold industry has been about for 40 years. The growth in my database is probably 75% people under 50. 35% of the new people in my database are female. We never saw that before. Mm-hmm. What we're seeing is that interest in gold now is more global. than domestic. So at the same time that there are outflows from gold-oriented ETFs, more specialized gold products, as an example, the Sprott physical gold trusts, are having substantial inflows. And retail investment in gold outside the U.S., particularly in India, Pakistan, China, Taiwan, Korea, Vietnam, is very, very strong indeed. So what we're seeing is an international gold market. We have better ways of keeping statistics in the United States because we can measure inflows and outflows to ETFs. But at the same time that we're seeing disintermediation from retail gold products in the United States, we're seeing increased gold ownership and hence escalated gold commodity prices on a global basis. The market's just changing. If you go back to 2023 as an example, there was a lot of frustration on the Kitco site about the fact that the gold price was up, but the gold stocks weren't up. That was easy to explain. Gold itself had a buyer, foreign central banks. And those foreign central banks didn't buy gold stocks. So an asset class that had buyers went up, while an asset class that didn't go up. The other thing that happened was that as the gold price went up, the cost to produce gold went up too. So the margins in 2023 didn't increase. When the momentum in gold continued into 2024, something very different happened. The price of gold, the increase in the price of gold outpaced the increase in the price of inputs to produce gold, and producer margins began to expand. That increase in producers' margins, coupled with the perception around investors that gold was a real asset class, meant that the producers who demonstrated performance went crazy in price. Look at Wheaton, look at Agnico Eagle, look at Alamos, look at Lundin Gold, look at Kinross. The people who delivered sustainable increases in margins were welcomed with 50 to 100% share price increases in the period January 24 to, let's call it, March 25. If you examine prior bull markets, what you will see is that trough to peak, the aggregate of the equity indexes in gold bull markets can increase by 250, 350, 500% peak to trough. So yes, the best of the best have moved, and yes, there's a lot of room left in the sector. If I'm correct, and over the next 10 years, the purchasing power of the US dollar declines by 75%, and gold experiences a concomitant nominal rise, the amount of room left in producer margins for the best of the best is extraordinary. What happens in gold bull markets, of course, is that as the best of the best attract the capital, their share prices increase at a faster rate than the rest of the market. And value arbitrageurs begin to look for better value propositions in lower quality companies. If that doesn't happen, the very high quality companies, the Agnico Eagles, take the other ones over. At any rate, it resolves itself. So leadership in the market will, over the course of the bull market, change from the best of the best down the value chain. Many investors, many speculators would probably be better off playing the bull market simply by owning the best of the best. They will likely underperform the equity aggregate over time, but they will do so with much less operational risk. Those investors who pay attention to the Kitco site, who pay attention in how to speculate or how to own gold stocks that are lower on the quality trail, can generate alpha if they're willing to do the work and if they're willing to take the risk. At any rate, my suspicion is that the next decade will be extremely beneficial for gold investors at the expense, I'm afraid, of broad society.